Good afternoon, fellow investors, and welcome back to the latest edition of the InvestTalk market analysis for the week ending May 10th, 2024. And this week's video is going to be titled Asian Decline, Continued Yen Weakness as Equity Bulls Party. And, overall, it was kind of a boring week. You had volatility, had it down, which I'll show, and you had a few economic pieces of data, but really not much. You had initial jobless claims that did tick up to the highest level of the year, really the highest level since, going all the way back to last summer. But if you go to continued claims for unemployment, that did tick up a little bit, but not much. Now, to be fair, you're going to need multiple months of this to have this breakout. But definitely a bit of signs of weakness in the jobs market after a poor jobs number last week for the month of April. But small data point, nothing major to freak out about. Consumer sentiment did tick down, though, to 67.4, the lowest level since last year. And overall, you had a mild shift in policy expectations. Obviously, the June meeting, it's still expected to be a pause. But going out to the end of the year, a week ago, you had about a 20% chance of three rate cuts, and now it's down to 15%. Okay. So you're starting to coalesce around more like 1 to 2 rate cuts by the end of the year. That's what you have here, 35% for each. So that's 70% odds you get either 1 or 2, and then 12% chance you'll get none, 15% chance plus that you'll get 3 or more. So that's what you should expect. And obviously, I've talked many times about how it's very, it doesn't matter as much what happens with rates, and it's more about the QT and or lack thereof. And then, they're pulling back at the beginning of June from 60 billion to 25 billion. So that will certainly have somewhat of an impact on liquidity in a positive direction, obviously. Okay. Now let's look at the markets today. This week, the S&P was pretty much strong throughout the week. Monday was a strong day. Pause on Tuesday. Kind of a pause, slightly up day on Wednesday. Solid day on Thursday, and then Friday was modest up day, right? Only 8 basis points. The MACD is showing signs of weakness here. Okay, so that's something to consider if you zoom out to a weekly. This did cross over, and we'll see if we can get across back up, but this could just be a consolidation area. Now, we pulled back to the 2.5 retrace. We've bounced. We have not recovered the all-time high, but that's not out of the question considering the dynamics of liquidity. Now, let's see. The high of this candle, breakdown candle, was 52.24, spot 81, 52 about 24, it's about 81, and we closed at 52.22. So we did not close above that candle, and that is crucial on a weekly basis. So something to take note of. It would not shock me to see a market rollover and have a higher low, and that's kind of what I'm expecting now because of the strength in this rally. If this meandered here around the 5,000 level for a few weeks, I would say this is going to break down and make a lower low. But this week kind of I wouldn't say takes off the table, but makes that less likely. Okay, so what's probably more likely is you get a gap fill here, and I'll show you that, which would be a pullback here. Let's call it 50.70 on the S&P. Okay, and that's probably what I'm expecting more is a controlled, choppy pullback into month end, and then you get a positive inflection point from there. Now, nothing is off the table. These are all probabilistic based on the patterns, based on the things that we're seeing in markets. And you have to focus on these other aspects. So this is number one. This would be the credit markets, short-term treasuries. Now, you did see weakness throughout the back half of the week. So that was interesting of note and kind of maybe portended to some weakness next week. So we shall see. But you're definitely getting some choppiness here, which does not tell you you're ready for an imminent breakout in equities. But overall, things are fine. So, base case is kind of a choppy environment to work off the overbought scenario, and that's really what this was, right? This was the market was overbought. Look at this straight up move since the fall on the Fed pivot, and they're following through on some of the promises of the Fed pivot, right? Still leaving rate cuts on the table, but not the 6 rate cuts the market had priced in at the beginning of the year, and then kind of following through now on QT, and actually a bit earlier than expected. I was expecting it more towards the end of the third quarter, and we're getting it more towards the end of the second quarter here. So that's something to take note of. But yeah, this is more of an area where you're probably getting a consolidation pullback, A, B, C pattern. We're in the B leg. C is probably next, and then that will do it. And then you could see new highs for the S&P maybe later in the year. The growth to value trade, this has been very choppy as of late. We talked about that rollover value drastically outperformed into year end. Then you had quarterly OPEX in the tech space, and that brought some strength there, rolling of option trades, etc. Now we are getting into quarterly OPEX. Um, sorry, January OPEX was a big one, and then you get quarterly OPEX, and we're getting quarterly OPEX next month, which could portend to higher prices for the growth side of the market. But overall, you're just seeing choppiness. Nothing is telling you one way or the other, whether growth is winning or values winning. Now, small caps definitely were weak on the week, and that's because rates continue to head higher, and that will weigh on that part of the market. What else do I want to get to? The move index here, that has rolled over, and that is not an issue by any means. The VIX also, we talked about volatility just being hammered down here. I mean, you're back down to near the lows, sub 13. Nothing to really worry about overall. The commodity index, however, that remains in a consolidation period here, and looking ready to break out to the upside. And it's important to follow these metrics. Here's the let me go to the dollar. Here we go. The dollar looks to want to roll over here. It's showing some weakness. And the yen, now let me cover the yen because that's the title of this video, right? This is the FXY. We had that currency intervention here, but it wasn't enough. This almost has reversed all of that currency intervention and looks to be headed lower. So this is where really the risk is in the markets. And is this going to be some sort of Asian financial crisis redux? I think that's certainly possible, but something to be on the radar for. And that central banks around the world want to keep the JGB market liquid. They want to keep the UK gilt market liquid, and there not be an issue there. Same with the currency, not just the debt markets, but the currency as well. And the currency with the yen, it's hard to imagine it finding any footing because they're kind of stuck between a rock and a hard place. They can't raise rates because they have so much debt, and that would just make their debt situation spiral out of control even more. But as long as the Fed is keeping rates higher for longer, that rate differential means that people are going to continue with the carry trade, which is borrowing yen at low rates and then buying foreign assets like treasuries. And so that means selling yen, buying dollars or other currencies, and therefore the yen is continuing to weaken. So I wanted to touch on that because that continues to be an issue that everybody should be following. Now let's get to the gold market. Gold, nice week this week. This is just a mild pullback, nothing to worry about, working off that overbought condition and looks to be headed higher. You continue to have to believe that gold is going to really reach, I think, continue to make all-time highs throughout this year and into next year. And so definitely an area that you want to have some exposure to in some way, shape, or form. Now let's take a look at the oil markets. USO, the oil was weak overall this week. Kind of a mixed bag on inventory, slightly bullish, I thought, but the market didn't react much to that. And I think we're going to need some weakness in the dollar and some continued stimulus out of China that is working to some degree, but not, I think, to the market's liking. So um, I still think you're going to get a choppy oil market, but in general, long term, I think oil is headed higher because, the OPEC nations, they want oil higher. It's clear that they want oil at least $90 a barrel, if not higher. And they're not going to open up the taps. Saudi Arabia still is holding back capacity probably until we get above 110, maybe 120 on oil prices. And I think over time, you get there in a choppy manner. Let's see the banking index that is showing some strength here. We're through earnings season, and there was not a whole lot to worry about on that front, despite the fact that rates continue to go up. What else do I want to get to? I think that's about it. Oh, this is something I'll be watching. The transportation index. This is showing some relative weakness here. This is a Dow Jones transportation. The FedExes of the world. They've had a bit of a pullback. You have Union Pacifics of the world. They're getting a bit of a pullback, but UPS is the one that was kind of hurt the most overall, even though I think it's a fairly good value down at these levels. But it's something to watch. If the transportation index continues to languish, that could be a harbinger for more economic weakness going forward. But just something to have on the radar. Nothing that says, "Oh, you sell everything just because transportation index is relatively weak." No, and that's something you have to understand in this business. It's not one factor that allows you or forces you or suggests you make a particular trade. If anyone's trading off of one data point, they're doing it wrong. Just like when you go buy a stock and it says, "Oh, it's yielding 7%," and you buy it because of that, you're doing it wrong. Okay, and that's why you see in these videos I talk about a lot of aspects of the market, a lot of data points, a lot of economic announcements, earnings announcements, things like that. It's in a big puzzle, and you have to put it together. And that's what I'm here to help you do, is try to put that puzzle together. And ultimately, that puzzle says you have to remain bullish. You can play the wiggles if you want. You can get cute, and I understand that. But it's about the risk versus reward, and the risk versus reward to markets continues to be the upside, because what is the catalyst for a credit meltdown? There really isn't one, right? You just had earnings season. Earnings are up about 5%. It's fine. Yes, rates are going up, but a lot of companies have locked in lower rates for extended periods of time. Yes, that in the high yield market, there can be some issues, but this is not telling you there's any issues in the near term. We talked about this. So everything seems to be okay. There are values out there. The market is not overvalued. There are parts of the market that are overvalued, but the market is not egregiously overvalued. You could argue it's modestly overvalued, but that's about as best as you can get. You cannot go and look at cash flows, earnings, revenue growth, etc., and say the market is drastically overvalued. It does not compute. You have, roughly markets trading at roughly 20 times forward-looking earnings. That's not extreme. It may be a bit elevated, but in an inflationary environment, equities tend to be a good hedge against inflation. 3-4% inflation is not a bad place to be. So overall, don't get too cute. We're in a seasonally weak part of the year. That's why you're getting a bit of choppiness. But as you can see, any little dip is bought up because of the underlying liquidity dynamics in the market that remain relatively strong, and likely will be strong through the election. And we're getting into 6 months to the election. Obviously, there'll be probably a lot of headlines, especially as you get closer to the election, September, October timeframe, and that's maybe when you get, I think, a bit more volatility in the markets. But in the near term, don't get caught up in that volatility. Stay with your plan, stay with your allocation, focus more on hard assets over the story stocks, shall we say, the Ponzi stocks. And that's what's performing right now. So I appreciate you all tuning in, and reminder that the contents of this video are for educational purposes only and should not be considered as a recommendation to buy or sell security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.